Good afternoon, everybody. Welcome. We'll give just a few more moments of time so others in the waiting room can jump in, and we'll get started momentarily. Well, let's go ahead and get started. Good afternoon. Welcome to our webinar entitled Unlocking M&A Success in a Shifting Landscape. My name is Aaron Mall. I'm the Executive Vice President here at iTValuations, and I'm joined today by Reed Warren, our founder and CEO. Reed, it's great to have you on the webinar today. Thanks for making some time.
Oh, this is really awesome. I really appreciate it, and it's great to have you guys all here and just to be able to talk through things. I want you to certainly feel free to put questions in the chat as we get going, because our goal on this is less about presenting this and just really being able to address some of the concerns and that you have in your mind as we look at 2024, 2025, and how we can best position ourselves for those upcoming years.
Fantastic. Yes. And I was looking through today's attendance read, and it looks like we have a few folks who attended our June and July webinars. So they're now, I think, groupies, right? They've gone to 3 in a row. And for those who are maybe new to our webinar structure, we have an ITV tradition of giving away an Amazon gift card, $50, to an individual who first, I guess you should say, correctly answers a question in the chat. We're going to ask that question. So we try to make the question somewhat related to one of the presenters. And so Reed is, of course, the main presenter today. And so the question that we have for you, and drop this in the chat, and at the end of the webinar, we'll actually let you know if you're correct. What was the first computer that Reed used for software programming? May be helpful to know Reed's age. He's probably 30 years old, plus or minus 25 to 30 years, give or take, right? So that might help you. But what was the first computer that Reed used for software programming? Put your guesses in the comment section. And again, if you're the first one right, we'll go ahead and send you that gift card. A couple of housekeeping items before we get started. And Reed, you can advance the next slide if you'd like. I want you to go ahead and save the date for our next webinar in September, September 17th. We're going to be joined by Arlen Sorensen of ConnectWise fame, along with Stephanie Kinsey, who is the CEO of Total Networks. Total Networks just recently transacted, and they're going to explore the transaction journey, exploring your why and the fundamentals of fit. So we look forward to hosting a conversation with Arlen and Stephanie on September 17th. You can register for that webinar. We'll actually have a QR code at the end, and I'll drop the registration in the chat here shortly. Next slide. If you're interested in connecting with us at IT Nation this year in Orlando, you can go ahead and email me at the email address below. We're offering complimentary quick consultations around any topics that you may have interest in. It might be evaluations, transaction readiness, potentially growing your value in preparation for a transaction at some point, our Value Creation Academy, which we'll be launching in January, or even maybe our IT CPA services. If that's something you're interested in, go ahead and reach out to me. I'm coordinating our meeting schedule at IT Nation, and we'd love to spend a little bit of time with you down in Orlando. All right, so let's get started. We're going to start by covering, this is the outline that Reed's going to talk through, but we want to talk through M&A trends in the first half of 2024. So now that we've gone through the first 6 months or so, what are we seeing? How do we see that changing as we head into really the second half of this year and then early next year? What market factors that we're seeing that are impacting those transactions? And last, the profile of the top quartile firms. So in essence, how do we take what we know about the marketplace and what's happening and apply that to our businesses so we can achieve the objectives we have heading into transactions? So Reed, I'll let you kick it off, and we're looking forward to learning from you today.
Yeah, so awesome. I mean, 2024 has been just such an interesting year, coming off of 2023 and 2022. Obviously, we've had just an interesting stretch since 2019, and we launched into COVID and all the impact of that. And so there's actually a lot of great correlations as we looked later in the conversation here, going back to some of the things that we actually saw through COVID, or 2008, when we looked at some of the recessionary periods that we've been through in recent history. But as we look at 2024, the interest rates have certainly peaked, and that's been high. That's created a lot of the pressure behind why multiples have eroded over the last 2 years. We really saw kind of the peak of the peak from a multiples perspective right around June of 2022, is where we saw some of the highest multiples ever. and into kind of the fall of 2022. We saw them retrace in 2023. And then as we came into 2024, a lot of that, because we go back to June of 22, we had unbelievably low interest rates, and the interest rates have gone up almost 6-7% since those times, as we look at it. So we continue to see the multiples erode, mostly because cost of capital has been consistently going up. The other thing is we're just seeing a widening range really between top quartile and bottom quartile. In other words, top quartile firms are still able to command premiums. There's still a lot of demand in the marketplace to buy healthy firms. At the same time, there's much more options in the marketplace than we've seen in 2023. 2024, we actually saw, just from a iTValuations anecdotally valuation perspective, we saw our valuations really start to tick up. We saw more sellers coming to the market, more people thinking about that. A lot of that, again, if you look back 2021, 2022, and 2023, you now have 3 years of historical growth in the industry. And so you have this environment in which a lot of maybe marginally performing firms, or firms that have just been floating with the economy, now have 3 years of kind of positive trends from a growth perspective, maybe doing 10%, 7 to 12% year over year growth rate. And a lot of that's because the industry's been growing at that rate. And so we see them kind of buoyed up by the marketplace. We obviously, as we start to look to some of the 2025 trends, we start to see, let me go back on that, a lot of dark clouds on the horizon. And so people are going, hey, this is probably a good time maybe to exit the business before something further happens, or we move into a recession, or depending on the administration that goes in, hey, maybe our tax rate's our capital gains is gonna go to 48% or something like that. And so we need to take action now. And so we see a lot of that kind of fear, uncertainty, and doubt that's creeping in on a lot of sellers who are looking to take the opportunity to sell now while conditions are known, and as opposed to conditions that are going to be unknown in the future. And so through that time, we've seen transactions here in 2024 actually slowing from a velocity perspective, although it's still very strong. It's still well above pre-COVID levels. But we are seeing that the seller market, or firms with 2 million and less in EBITDA, more of them are coming to market today because of what we just talked about. At the same time, we're seeing this balancing in the supply demand. So if we were to go back to 2022 and through a lot of 2023, there was 4, 5, 6 buyers to every seller in the market, which created this very much the seller's marketplace. As we come into 2024, we're starting to see that balance. And as we start to look further into the second half of 2024, we really are going to get to in that sub 2 million in EBITDA category, a much more balanced market of buyers and sellers. What does that mean? That just means that buyers don't have to buy a seller. So if you're not a top quartile, I have other options that I can start to look at, other ways to be able to get it done. It gives me more room as a buyer to put downward pressure on the transaction for all the company specific risk related items that you may have in the industry. Probably the last piece that we're seeing in 2024, again, because of that pressure and people trying to get to their personal wealth targets, we're actually seeing an increasing number of kind of bundles and candidly mergers where companies are coming together to kind of bolster up their EBITDA, their operations, their revenue size, to be able to try to transact at a higher multiple as a result.
Yeah, that's a fantastic overview, Reed. Just a quick note for those of you who maybe jumped on a little bit late and you're in the comment section saying, why are people entering the names of random computers? We have a giveaway where we'll give away a $50 gift card if you can guess the first computer that Reed did software programming on. So the first computer Reed used for software programming. I want to circle back, Reed, to that last bullet point, which is that increased in bundles and mergers. Can you, obviously it's in response to those 5 bullet points above, but can you talk about the difference between a bundle and a merger and how that works just tactically in this environment?
Yeah, we've got a number of these projects going on. So on the merger situation, it's really where we have 3, 4 companies, and it's surprising to me the numbers that are coming together. It's not just, hey, 2 companies coming together and merging. It's like 3, 4 companies coming together and merging. We've had subsets of a peer group come together and say, hey, how do we come together and really drive up our our EBITDA, our kind of our volume of business, bigger is better. It allows us more latitude to be able to add other services that we couldn't necessarily afford as a smaller firm. So we're seeing a lot of this in that anywhere from kind of 300 to maybe 700,000 in EBITDA type MSP that's coming together and say, hey, if three of us come together or four of us come together, we can now get to a place where we start to encroach on that $2 million in EBITDA, now maybe being 12 million in revenue. And if we can sort out and integrate and consolidate some of the stuff, we can now position ourselves to, rather than trading at a 4.5 or 5x multiple, we can start to trade at maybe an 8x multiple, maybe a 9x multiple, depending on those items. And so as a result, what they are doing in the merger is they're not going to market right away. They're actually going to take on the responsibility of integration and consolidation in preparation for a sale, probably in a 2-year or 3-year timeframe. The bundle is really, we're going to sell today. So we have 3 or 4 companies or 2 or 3 companies that are going to come together, and we're going to sell simultaneously as separate companies. But here's the strategy that we have, where one of the companies is really anticipating becoming the platform. And so we're going to simultaneously close on 2 other smaller transactions. And together, we're working on one right now that together, they're going to be right around 30 million top line, $5 million bottom line. It's an ideal kind of platform play. I will just say this. The bundle is a much more complicated transaction because you have to have three sellers all agree on the same kind of structure, which gets really problematic, but can be done. And so some of the stuff that, and I know some of the people on this call have also been down that journey and can understand some of the complications with that.
That's great. Thanks, Reed.
So, as we look at the second half of 2024, we're anticipating interest rates are going to be staying stable. Not a lot of change on that right now. Obviously, we have a looming election, and typically, when we get into election year, we typically see about this stage in the game. So coming through July, people really don't take a lot of big actions or make any big moves coming into election because they want to see how that works. So we're seeing that, and a lot of our MSPs who are particularly on the product sales side, where product sales have really slowed. A lot of that is because concerns about where things are going to go. The irony of all of that is it almost doesn't matter who wins. There's creates pent-up demand, and we see typically a lot of activity post-election before the end of the year, trying to either maximize for tax impacts before any tax changes might occur in the subsequent year. Or simply looking at it going, okay, now that we have much more of a known set of future events, we know what administration is going to be in, we know how to respond to that. So we do see in election years kind of this pause before the election. The reality is buyer demand continues to be high. There's still 146 PE firms that are looking for platform companies. This is creating for, if you're over 2 million in EBITDA, or you can bundle yourself into 2 million in EBITDA, there's still a lot of buyers in the market looking for a key player. If you're below 2 million in EBITDA, we're going to continue to see those multiples kind of erode, predominantly due to the balancing between the buyer and seller ratio. We're getting much more closer to that 1-to-1. As we look into 2025, we're actually expecting cost of capital to improve. We anticipating the Fed's already kind of announced that they're anticipating reducing interest rates. That's going to alleviate some of the pressure on the cost of capital. One of the things that we're seeing across even our private equity buyers is because the cost of capital is so high, there's just a lot more scrutiny going into the transaction. There's less room for error. If you go back to 2022, there just wasn't that same gap between top quartile and bottom quartile because there's enough ways we can make this work. We can return on investment. Today, it becomes a much heavier analysis to make sure that we actually really have a winning horse, or we have a clear path to be able to get to that return, to be able to make that work. So again, we anticipate with interest rates dropping, that'll be easier. Cash will become easier to become available. If we do hit any dark horizons, we saw through COVID, we saw through 2008, that MSPs are really viewed as a safe haven from an investment perspective. And so we saw coming out of COVID, we even going back to 2008, when public markets struggle, wealthy people like to get a return on their investment, they've got to do something with it. And so we've seen in when there's been recessions or pullbacks in the marketplace that the IT services, specifically the MSP marketplace, is one of those best investments because it's something of a safe haven. You can't turn off your IT services company or your managed service company without closing your business. So yes, there will be some attrition on your customer base, but candidly, any business that's going to get through it is going to continue to keep their infrastructure functioning, which means they have to have their managed services involved. And so, even if we do have some broader pullbacks to the market in 2025, that's only going to add more fuel to the fire, so to speak, or make the buy increase the buying demand by private equity companies and other private owners or family funds that are going to look to um, uh, improve their return on investment by doing acquisitions in the IT services space. Again, below 2 million in EBITDA, it becomes too expensive to get transactions done. And so we're going to continue to see erosions of multiples as we look into 2025 if you're below $2 million in EBITDA.
Yeah, real fast, Reed.
Yeah.
I wonder real fast. I mean, I think obviously you want to be in that above $2 million EBITDA because multiples are higher. You're almost a little more immune to some of these economic factors that are happening. But before we get to, so you want to have those behaviors that make you a top quartile firm, which you're going to talk about in a minute. But before you do that, we had a good question in the chat related back to the bundle merger thing. And I think it might be worth calling out. So I think it's a question we're often asked. The question is, how does the degree of integration or lack thereof impact valuations in these combinations that you're referencing? Can these companies be successful with an eventual sale process if they don't really integrate?
Yeah, good question. It really, this may sound bad, but it really comes down to the narrative, right? In the end, in the situation that we're working on right now, we have it's part of the go-to-market thesis that says, hey, we could all, the company that's looking to become the platform could actually go out and get financing, do the acquisition of the two smaller ones, do the integration, do that whole piece, and then turn around and sell in 2 years. The buyers, the buyers that were looking at it, looked at that and said, "Hey, but we're already going to do our integration. Why do integration twice?" And so, in this scenario, because there's a good cohesive strategy for how the primary company or the platform company was going to assimilate, they had an integration strategy. They had all the components. We had a clear organizational chart of what the new organization would look like, how everybody played into that. In the end, the buyer looking at that has a high degree of confidence in that as a cohesive strategy. Where we've seen a lot of those fail is like, hey, here's three companies together. We're really not sure how they connect well. Hopefully this is all going to work. And in those situations, we're not seeing the lift. So if you look at doing some sort of bundle, it's really important that that bundle, you really treat it as one entity. So in our situation, we consolidated all the financials. So it looks like one set of financials going back 3 years. We did all the customer analysis based upon it as one entity. And so from a representation perspective, it feels like and functions like very much one entity, even though it's going to be broken into three letters of intent, three purchase agreements, and all those different elements are going to be on a one-on-one. I would say it's certainly a path that can work. There's just a lot more you have to put into it, and candidly, not every buyer is going to buy it. So we do see a lot of buyers that just kind of looked at it and said, "Yeah, no, we're not going to pay a premium for that. We're not interested." We had others that said, "Hey, we'll take a look at that," and we're so. I think a lot of that's going to be building out a great cohesive strategy for how you're going to be able to execute on that strategy with or without the PE backing. That makes it a very compelling case to be able to say, hey, for a PE firm, we can believe in the strategy and we can actually acquire that as a strategy.
Thanks, Reed. So talk about these. So switching back now, the behaviors of those top quartile firms.
Yeah, again, we're just seeing a lot of demands out of the marketplace. And so, the marketplace is becoming more sophisticated, the end customer, and really looking for, we talk about it being personalized, flexible IT services. I want to be really careful with that. Not to rerun an old commercial, but Burger King used to have this, BK, have it your way. Well, if you went into Burger King, you didn't get to order spaghetti and you didn't get to order, pot roast. You ordered a hamburger and you had options 1 through 8, and then you could have the sub selection of changes you could make it. but they were able to market it as, hey, have it your way. I think in many ways, we're looking at a situation similar to that that says, hey, best in class companies are really good at this sort of mass customized solution that says, hey, here's our solution. It comes in these three flavors and with these, maybe three or four options to each one of those flavors. And so you can customize it so it feels personal to me, but it doesn't functionally change the delivery or doesn't materially change the delivery of services. And so a lot of that is a sense of personalization because you're now adapting to be able to meet my needs. At the same time, you're in a different situation where you're not creating, this a la carte menu where you can have any kind of combination. You really have a very prescriptive process. Again, I'm not trying to oversimplifying it by using Burger King, but in the end, you ordered 1 through 8 with, medium, small, or large. Those are kind of things. And if you wanted a Frosty at the end of it or whatever their ice cream cone was, those were those kind of options on it. So being able to take that, standardize your set, being able to put a handful of customizations on it so people can be selective and personalize it to their unique situation is really going to be critical going forward. We're also seeing just kind of that all-encompassing, all-in comprehensive marketplace. A lot of that flows out of the second to last item, which is democratization of technology. More and more today, the buyer today is not a technology person, it's a business user. They don't really care what the cybersecurity tools are that use. They just want to know, is their data secure? They want to know that you have a system being able to respond and respond quickly. And so it's becoming more and more tool agnostic, expecting you to manage the complexity of the technology and just assure a business outcome. And so they're looking for that kind of all-in service that's going to cover the bandwidth of needs that they have as a customer. And then they're also really looking for companies that are going to be leading edge and not laggard. And again, this becomes a lot of that rationale for merging that just says, hey, if I'm a $3 or $4 million MSP, I can't necessarily maybe afford to have a SOC 2 compliance center, but if four of us come together and we do some consolidation, we can start to leverage our capital to be able to move into being cybersecurity continues to be a big theme, but even moving into AI and automation that's going to continue to drive efficiencies across the business. More and more of the end customers expecting us to be understanding of AI and understanding the complexities of security. And so if you don't have those features, it becomes really hard to be industry leader, and you're going to find, just even in your marketplace and customer base, this general movement away from you because that actually presents risk to them as business owners. And then we've talked a lot about being specialized, verticalized, and productized SVP. Really being able to focus on a vertical. We see some of the highest bill rates, highest profitability, highest growth companies are really specialized. That's the technology set verticalized in a specific industry. And then fundamentally, because people are wired to buy products better than services, the more you can make your service feel like a product with here's the definition, here's sort of a fixed price, it's easy to consume, easy to adopt. It makes it really easy to be able to procure that service. Because it's already relevant to me as the buyer. So obviously you need to do your market analysis on that and make sure we see people verticalizing in, legal 5 to 50 person law firms. We see people focusing on dental IT. We see them focusing on hedge funds, financial services, a lot of things out there. But the more relevant you are, we're seeing some of the highest bill rates that are out there or per user rates when you start to go down that verticalization path because you're able to command a premium because of the direct relevance that you have to the customer. And then finding ways to move everything in as a managed services. This comes to transaction values and some of those other elements. But, when you look at being 75% plus or encroaching on 90% reoccurring, the only way you can do that is you've got to be able to make that shift from not only just managing service, but able to weave in projects as a part of that subscription service, as well as hardware into that subscription service. It eases the tension for you on the organization when you roll in hardware as a service, because now you're able to update their equipment in a 3-year cycle or a 4-year cycle, where if you're doing it as separately, now you have companies that are hanging on to their products longer, which poses an increased security risk and also support additional support expenses to be able to do that. I think from a numbers perspective, this is what we see from top quartile firms or where PE or buyers really get excited about doing an acquisition. It's EBITDAs that are in that 17 to 22%, organic growth rates that are 18 to 23, year over year organic growth rates, gap aligned financials, few, and kind of with gap aligned, few owner discretionary expenses being run through the business, running really kind of clean books that, customer concentration less than 15%, revenue expansion within that customer base, 105 to 108%. So you're seeing 5 to 8% growth out of your existing customers, while seeing on top of that net new revenue from new logos that you're putting on the board between 12 and 15%. Recurring revenue is higher than 75, and certainly the market differentiation becomes more and more exciting. We see PE buyers coming to us all today saying, "Hey, I'm really looking for somebody that focuses on not just healthcare. We're looking for somebody that focuses on orthopedic or dental or some of these subsets of the industry." And so deeper penetration into that makes you a lot more valuable to a prospective buyer than necessarily being a geographic generalist. So some of the other things that we want to take a look at, it just, as we do valuation work, we actually look at 26 different or 24 different company specific risk factors. When you look at top quartile, it's really about managing these company specific risk factors. My goal today isn't to work through all of them today, but this is just kind of a subset of those that we look at on a regular basis, and the degree to which you can impact them impacts the risk that a buyer is going to take on when they look at doing an acquisition. So all of this stuff drives your value up. And so the better the scores on these risk factors, the lower the risk the company is, the higher the price that buyer's going to be willing to pay. The reason for that is because there's just less remediation, less concerns. It becomes much more predictable about the outcome. And in the end, it's about predictability for almost any buyer over the I'll pay a premium for predictability because I know what I'm going to get, versus the risk of the unknown that, hey, something may bite me.
We talk a little bit about maybe there's some folks on the call who own an IT firm. They're not at that a top quartile firm. They're maybe not at $2 million of EBITDA, and they want to get there. How does ITV help those folks realize maybe a higher valuation and help them reach their personal wealth targets?
Yeah, so I think one of the main things, and so as we looked at it, part of the reason we created valuations as a service, we were doing annual valuation for people, and people come in, they do it once a year, every 18 months or something like that. And what happens when you do the valuation, we work through these company specific risk factors, and we really kind of assess you on those, and people would walk away with some great insights. I mean, customer after customer would say, "Hey, I felt like I learned just so much in that journey." They would go work on those things that were company specific risk factors to improve the value, but they'd come back 12, 18 months later going, "Hey, I hope we got there." And it's like, wow, I found out more, right? And so much what we launched when we did valuations as a service is we wanted to be able to put that onto a dashboard. So it's an annual valuation plus quarterly updates to it. We're basically charging the same price as we do for evaluation. We just turned it into a subscription model. We pull that data quarterly. So there's initial setup to get it all set up. But then as we look at this, we can track your valuation. When we do the first valuation, we actually do last 5 quarters valuation. So you can see how you performed on the previous 5 quarters. And then, hey, where do you stand today? And then with every quarter, as it gets done, we'll do the valuation. It updates it. You'll see, on those 24 different risk factors, kind of where you land, the levers that you need to pull to be able to drive that up. We have a quarterly business review with you on a quarterly basis to be able to just talk through that, answer questions. How do you make this work? How do you actually transform this item or these pieces? And a lot of these pieces just take time. And so again, as we look through it, our goal is, hey, look at your trend line from a value creation perspective. We're also looking at your forecast from a growth perspective. We can get pretty good at being able to hit, hey, when are you going to hit your personal wealth targets? And now we can now create a plan on how you get there, steps you need to be taking today. Do you need to set up a due diligence portal and start to collect all that data? What are those functional steps that you can take today to be able to, really, our motivation is for you to be able to harvest the, 20, 30 years of hard work that you've spent on growing your business. We see time and time again where sellers come and they're just tired and they're ready to exit. And candidly, they're leaving $500,000 to a couple $1 million on the table without the energy to be able to make that happen. So much of what we wanted to capture here was be able to get the tactical ways that you could change the value in preparation so you could maximize the harvest of your hard effort and labor over the last 30 years of running and owning an MSP.
Thanks, Reed. That's definitely a great overview. If you'd like to get a personalized demo of the valuations as a service solution, actually talk through how we're seeing our clients utilize it to drive higher values, happy to do that. You can scan the QR code now. We also launched IT about 5 weeks ago, and the demand has been pretty incredible early on. Folks have CPAs, and I think there's a gap between what they need from a CPA and what they're receiving. And so, love to have a conversation, facilitate one with you and Greg Northrup on our team, who's the managing partner of IT. So you can do that by scanning the QR code. Couple quick housekeeping items here as we end. Don't forget to save the date. Next slide for our next webinar on September 17th. Arlen Sorensen and Stephanie Kinsey talking through the transaction journey. Our goal actually over the next few months is to actually walk through the transaction journey step by step and just help you mentally prepare for and think through the things that are going to be a part of that process and journey so you can go in as informed as possible. And Arlen, of course, highly respected. Stephanie Kinsey, just a phenomenal CEO of Total Networks. And so we're happy to connect with them in September. And then last but not least, we will see you in Orlando at IT Nation Connect. If you want to talk about any of the things we're seeing in the marketplace, anything related to valuations, transaction readiness, value creation, IT, or just, grab a drink. We'd love to connect with you. But we cannot leave and really adjourn the webinar until we get Reed's answer on the first computer he programmed on. I think we've got one close enough to award. So Reed, why don't you tell us the first computer?
Yeah, 1982 was when I started. I was so incredibly excited because I got the full package. I got a Commodore VIC-20. It had a tape drive, so you put a cassette tape in. It had an incredible 5K of memory. I was so excited about that. Really jumped into programming early on, was an early adopter. But yes, taught myself BASIC, later on Pascal, Cobalt, C in my journey. So when I launched in the early 90s, I was actually doing C Unix on AS400s. Not to totally date me. I did have somebody come back and ask me if I wanted to do any AS400 development. He could pay me $350 an hour if I still would be willing to do it. I won't do it anymore. There's a good reason why I got out of it. But yes, goes back to the early years of Commodore VIC-20 back in 1982.
So if you're under the age of 40, you might be like, what did he just talk about for 5 minutes? The answer that's closest is Commodore 64. Reed, will we say that's close enough?
That's close enough.
Okay.
I will say that only because I upgraded 2 years later or a year later to Commodore 64 before going to my first IBM 8088 with the Intel processor. So and I'll never forget how revolutionary the first floppy disk drive was. That was just like, oh my gosh, heaven had come to earth.
So what you're saying is the person who said Commodore 64 actually has you younger than you really are. So so he wins the prize solely for that reason. He thought you were younger than you were. So no, in all seriousness, thanks, Reed, for your time. And thanks for all to you who joined us today. We'll be in touch about the gift card. Dennis, congratulations on that. And we're looking forward to connecting with you guys next month at our webinar and then in Orlando in November. Thanks, everybody. Have a great afternoon.